Yeah, shall I go ahead? Okay. Good afternoon, everyone in North America. Good evening from Geneva. Thank you all for joining this panel on climate risk management, filling the gaps. Some of you may be able to tell that I'm not actually listed on the billing to this afternoon. My name is Paul Smith. I work for UNEP's climate team. Just here to give a quick 5-minute introduction, not only to the panel, but also in advance of a report we'll be publishing on TCFD methodologies and tools available for financial institutions. And this will be a report that coincides with the end of our phase 2 banking pilot on TCFD. And the report will be published on our website in mid-November. As many of you know, we've been running pilot projects with various financial institutions since 2018. Two of those institutions are represented here this afternoon on this panel from Citi and TD Insurance. The pilot projects that we've been running have been supported by a number of methodology providers, including Oliver Wyman, Carbon Delta, now MSCI, and now PricewaterhouseCoopers with insurers. Our 2019 report on climate risk for investors, a report called Changing Course, which you can find on our website, of course, included in its chapter 2 an overview of the main climate risk specialists for financial institutions. However, since May 2019, when that report was published, there have been many developments, not only in the climate risk tool market, but also in the regulatory landscape. So in order to mark those the rapid change in developments in the field, this report will provide an update for the finance sector on physical and transition risk methodologies. It will also provide a review of scenarios as well as regulatory and technological developments in climate risk assessment and disclosure since May 2019. And in conclusion, the report will provide some recommendations for improvement in risk assessment methodologies, as well as highlighting some regulatory landmarks in the upcoming year, 2021. Just for a little flavor of some of the conclusions of the report and some of the trends that we have identified in the landscape of TCFD methodologies and tools. Since 2019, in the regulatory space, a number of central banks and regulators have been stepping up their risk frameworks. Article 173 has been updated in France. The Prudential Regulatory Authority of the Bank of England has published guidelines, and there will soon be published an update to the non-financial reporting directive of the European Union. Increasingly, stress testing of climate risk is becoming very important in a handful of West European jurisdictions, such as the UK, the Netherlands, France, and soon from the European Central Bank. In the North American region, the most recent update from the SEC on non-financial disclosures overlooked climate risk assessment, though the high risks of ignoring climate change have been outlined in a recent report last month from the CTFC, and Commissioner Rustin Bainum will be speaking about this report in a panel after this one at 1 p.m. Eastern Summertime. In Canada, the Bank of Canada is only at the exploratory stage of developing climate risk assessment guidelines and stress testing. There has been some emphasis on climate risk assessment in the Government of Canada's post-COVID support in the form of the large emergency financing facility. But one of the conditions to this financing was to produce climate risk disclosures. And needless to say, it's been somewhat of a challenge for businesses to achieve this, and requests to this financing have been fairly limited. So there are ongoing challenges in North America, clearly. In terms of the climate risk tool providers out there are a number of updates and technological developments. They're increasing the breadth of their scenario options and data analysis, increasingly through AI and data mining. They're increasingly responding to demand for stress testing options and also develop portfolio temperature alignment modules, which will hopefully allow financial institutions to move from risk management to increasingly portfolio alignment. Many providers are also integrating both transition and physical risk, which so far have tended to be assessed separately. and this will help to provide a holistic picture of climate risk. And because of these increasing trends of big data, developing both transition and physical risk methodologies, and different, more bespoke options for financial institutions, there's been quite a consolidation of providers in the sector. For example, Carbon Delta joining MSCI, 427 and Vigeo Eiris joining Moody's Analytics, 2 Degrees Investing teaming up with Carbon Tracker. And there has been increasing competition from a number of other providers traditionally oriented towards insurance, such as RMS and VRisk, and other consultants such as PwC and Baringa Partners. So this really provides, just in a nutshell, some highlights from the report for mid-November. But that's all from me. The show will go on, and I'd like to hand over to Layali for a very interesting panel event from here. Thank you so much for your time.
Thank you so much, Paul, and we definitely look forward for the update and to know more about the trends and updated methodologies and tools available out there. And on that note, I'm happy to continue this discussion with our panelists. This panel will discuss more on climate management in terms of climate risk management in North America in particular, in comparison to other parts of the world, and focusing on different approaches that are taken by financial institutions while addressing key issues and how we can drive the transformation forward. I am the North American Network Coordinator with UNEP, and I'm happy to dive into this discussion with our esteemed panelists. We have Eliza Eubank, Managing Director and Global Head of Environmental and Social Research Management at Citi. We are joined as well by Moira Gill, Associate Vice President, Government and Industry Relations at TD Insurance, who is also a member of the Principles for Sustainable Insurance Board. And finally, we have as well with us Jennifer Reynolds, who is the President and CEO of Toronto Finance International, and also sits on the board of the Financial Centers for Sustainability. I'm very lucky to be joined by you today, and we will start the discussion after the introduction that Paul has given us on the update on the landscape. It was indeed a very challenging year, to say the least, and the pandemic has nearly brought the global economy to a standstill. It might be a tipping point that we can address the transition to a low carbon economy and build back better, as we heard from previous panelists throughout the day. And I will start with a discussion to hear more from you, Jennifer, about, from a financial centers angle, how do you view the maturity of climate risk assessment and integration in North America, and even in comparison to what you are seeing across?
Well, I think certainly we are sort of at the beginning of the road, at early stages. It certainly does vary relative to, depending on the industry that you're in. I think, if you're in the financial services industry, if you're insurance, these types of industries, pension funds, there's a much greater sophistication around, the analysis and disclosure and awareness of the issues. But if you go to smaller industries or you go cross-sector, I think we're at the beginning stages. I think it's going to take time for really for different industries to get a handle on this. But certainly if you think about institutional investors, they're demanding it. So this isn't something that people can wait on. I really think across financial centers globally, everyone understands that capital is moving based on these types of factors. And so every company is going to have to address this. From the Canadian context, certainly we've seen the big banks, insurance companies, pension funds, all have adopted TCFD. We have a coalition here in Canada for good governance, which is comprised of institutional investors, and they as well have adopted that. So we are certainly seeing it happen. We're seeing much greater, as I said, sophistication around these particular issues. And I think the other thing I would mention too is, Canadians, certainly Canadian banks in particular, have always prided themselves on being good managers of risk. And if we're not going to get good at this, we're never going to be able to be good managers of risk. I think if we think about the last financial crisis in 2008, our financial institutions did better than others comparatively. But for us to continue to have that kind of stability in our banking system, these issues absolutely have to be well understood. Disclosure has to improve, and it's going to happen across sectors, certainly.
Well, thank you, Jennifer, for that. And I think you bring us to a very good, important point here about banks in particular being good managers of risk. And I understand that the opportunity that climate change presents is as well a daunting task. And I think that will take us to a question to you, Eliza. And speaking from the US and as well from a banking perspective, on how do you see with the pandemic the maturity from Citi, who has been very active and engaged on the TCFD recommendations and integration of climate risk. How do you see that brought us forward or provided deeper integration of risk assessment across industries?
Yeah, thanks, Layali. And first, I just want to make one correction to my title from your introduction. I'm not research management, I'm risk management. There's a whole great area of Citi that does good research, but that's not my area of specialty. Although, in order to be working on climate risk management within banks, we need to kind of constantly be on top of the latest research that's coming out. I think I've been here at Citi for 13 years, always in environmental and social risk management, where we've always looked at climate risk, but it's been one bullet on a long list of the various environmental and social risks that we look at. And within the last couple of years, it's really climate has sort of taken over kind of as the one big issue that everyone wants to talk about. And we're seeing a lot of regulatory trends globally, in Europe and in Asia, where the regulators are pushing a lot further than we're necessarily being pushed right now in the US. But in terms of talking about the COVID pandemic and what impact that's had on climate risk assessment, I think there's some interesting learnings that we're taking from this, because a lot of the resources that initially in the beginning of the year were focused on climate risk stress testing were a little bit shifting to looking at COVID response stress testing and kind of how a rapid shift in global activity driven by the pandemic, a rapid drop in oil demand, rapid drop in travel, how that impacted the credits across our portfolio. And I think that's provided some interesting learnings that we're able to kind of weave back in as we pick back up the climate risk stress testing, because sometimes the challenge with doing the climate risk stress testing piece of the puzzle is that you're trying to look at long-term trends. But sometimes long-term trends you may have time to adapt to, whereas the short-term shocks can be what can lead to kind of a greater credit risk in a portfolio. So I think that's been an interesting way that the COVID pandemic has sort of impacted climate risk assessment. And another way, as I said, is just the rapid drop in oil prices. I think right before COVID hit, we had done our latest internal climate stress test on a short-term shock to the oil industry. And then we had kind of a real, which at that time was about a rapid onset of a carbon price. With the pandemic coming on, we had kind of a real world test to see, okay, how does this short-term shock of a drop in oil demand impact our oil portfolio? So that's a little bit of real world testing. And then just the last point I'll say in terms of like the COVID impacts, people ask, has COVID led to kind of downplaying a shift away from sustainability, climate risk assessment? And absolutely not. I think we're definitely seeing that people are talking about when we come out of this global downturn, how can we bake in more kind of sustainability objectives and climate risk protections into how we build back the economy? So I think that's something we're going to see more of over the next year.
Absolutely, Eliza. I would say that the pandemic was a live case scenario and representation of, if we did not like the pandemic, we are not going to like climate change. And I think one of the industries that provides that perspective, the insurance industry, knowing how to manage risk and has the core insight into that. Moira, from your perspective, how do you see the approach to climate risk assessment and disclosure and in terms of the industry's understanding of the steps and the needs to transition moving forward?
Thanks, Layali. Well, as Jennifer mentioned, consideration of climate risk is certainly moving to the forefront with the financial sector and certainly with Canadian insurers. For general insurers, it's very obvious. The increasing impact of floods and wildfires on our customers and core operations is evident. But the operations connection is maybe not as well understood, I'd say so far. Although on the investment side, there's been is a natural place to consider this. I'd say we're now getting the needed structure and expertise around the consideration of these risks. So over the better part of the last year, I've been part of 22 insurers around the globe that have been working together to explore and pilot methodologies insurers can use towards implementing the recommendations of the Financial Stability Task Force, TCFDs. I'm really happy to say there's significant Canadian participation in this initiative. We've got 5 Canadian insurers involved, which is fantastic. And our group recently published a report, progress update on our work, and we'll be releasing a final report at the end of the year. So we're certainly coming along very quickly. As to how the insurance industry can contribute to accelerating the transition, as risk managers, insurers, and investors, we've got a broad impact on the economy. So how we address risk, how we engage with our customers, it also has an impact on the community level. And as different insurers, from a competitive point of view, start to develop new products that address these risks, new services, or get involved in consumer and customer education, I think we can contribute to building really resilient, inclusive, and sustainable communities.
Well, that would be something that would be very inclusive and supportive for all of us on the transition. And I think this is something that is good for us to stop at and discuss further into details, Moira, which is a very important point in terms of our collective work towards aligning to a future that is below 2 degrees. There is a constant understanding and evolvement in terms of not just climate risk, but broader environmental risks, biodiversity risks, and as well social risks, in terms of the regulation and the collaboration of an ecosystem. Eliza, I would like to hear more from you, not just as a US bank, but as a bank that operates globally, as a license to operate, and as an understanding and focus on climate risk. How do you see that difference in terms of approach from regulations from the US, from stalling behind peers, and whether, especially if we look at standardized disclosure?
Mm-hmm. Yes. Well, you know, Citi is a global bank. So, you know, even though we're based in the US, you know, we still need to meet these regulatory expectations that are around the world, that are popping up around the world. It does, you know, make it a little bit more challenging for us versus the European banks when kind of their home countries, their home regulators are the one pushing this. So sometimes, you know, we see a very different perspective on kind of the importance of integrating climate risk from of course, our European regulators versus our US regulators. But US regulators are still paying attention to this issue, right? I mean, we mentioned that the CFTC came out with their recommendations for how US financial regulators can address climate risk. And I think one of the key recommendations that the banks really, you know, applauded and held up was the recommendation for the U.S. to formally join the Ngfs, right, the Network for Greening the Financial System, because, you know, whatever happens, we want to make sure that we're not needing to respond to 50 different types of regulatory expectations, 50 different structures of climate stress tests. In you know, the different jurisdictions where we operate. I think it's really important that whatever gets developed in the U.S. is kind of aligned with and built on the learning that's happening in kind of the international community with the NGFS. So I don't really feel like the lack of regulatory action in the US is holding us back, because it is such a quickly moving space that in a way it's sort of hard to make regulations at this point that are really fixed in time, and to pretend that anyone has the answer of how you should be doing climate risk assessment, how you should be rating your clients based on climate risk. We're all kind of learning together as a financial ecosystem, right? The data providers are still developing their products. We're still working on our methodologies on how we might integrate this into credit risk. And I think another good thing that came out of the CFTC report is that there was a real emphasis on flexibility, that there needed to kind of continue to be this sort of sandbox or learning lab type approach. Because what we don't want is to set in place a lot of rigid regulations today that kind of force everybody down one path of analysis, and we get 5 years down the road and we figure out actually that's not the way we should be looking at this. Maybe we've been analyzing the wrong things. It's been leading us in the wrong direction. So I think there's going to need to be this continual learning and this kind of continual feedback loop where we test certain strategies, we see what it tells us, and we kind of update it for the next, whether it's climate stress tests or credit risk analysis approach that incorporates climate risk. So.
Well, absolutely. And I think that references very well to what was discussed at the opening remarks today by Mark Carney in terms of taking NGFS scenarios as reference for banks, and then for them to adjust them as based on their knowledge, their exposure, and to have that dialogue that, as you mentioned, provides that flexibility for us to learn further and build on that body of knowledge. But I think that would be something to discuss and hear your views as well, Moira, in terms of, you mentioned the participation integration of climate risk is not something new for the insurance industry, but more broadly in understanding the TCFD in particular, the pilot that you are taking part of. How do you see that understanding more or less in terms of climate exposure integration underwriting? How can you see that driving product developments and market integration and speaking to the broader stakeholders as well?
I think we're actually beginning to see a transition from assessing climate risk products and services to help customers understand and manage their risk. So traditionally, insurance assesses a risk, prices a risk, and then pays out if that risk materializes. And what we're starting to see are products that help customers manage their health, help customers reduce their eco footprint, help them reduce the risk of water damage, for example, or their fire risk, factors that relate to climate change. So it's really a fundamental shift in what insurance is, I think, that we're starting to see. We've also, in terms of recent large-scale flood and fire catastrophes, the industry has been really vocal about not rebuilding in known areas of high risk, such as floodplains, and subjecting people and local economies to a repeat of that disruption and that real personal peril. We've also been involved as an industry in investigating building materials and advocacy for building standards, which reduce the risk for consumers and communities. So beyond the very obvious and blunt instruments of increases in premiums, which are a direct lever to change behavior, we're all looking at many different ways to change behavior and reduce risks. What we're increasingly doing, and what I think is most effective, is working with a variety of different stakeholder groups where we can contribute our knowledge along with that of others to initiatives that are going to reduce individual, community, and regional risks.
Well, I think that also connects, if you allow me quickly to come back to you, Eliza, before I turn back to you, Jennifer, on a very good point raised by you, Moira, in terms of working and understanding the new products and how you take that knowledge of integrating climate risk into the product and into the strategy. And I think, Eliza, to you as a TCFD's major pillar in terms of strategy, how does your development and growth of understanding of climate risk integrate into your dealing with your clients and customers?
Yeah, that's an interesting question, because I normally think of kind of risk and opportunities, a little bit separate, right? Because on the opportunity side, I think we've seen a real growth in the sustainable bond market within the last year or so, and that's an area that has not shown a dip in response to COVID. Because the year-to-date issuances of sustainable bonds, whether they're green bonds, social bonds, or kind of sustainable covering all of them, has just broadly outstripped this time last year. I think, let's see, there's 189 billion of green bond issuances year to date, and 67 billion of social bond issuances. And that's more about how companies can commit that they're raising funds towards a specific environmental goal, et cetera. And another interesting development is we're seeing a lot more in the ESG-linked product space. So not just saying I'm going to raise funds to use it towards building more renewable energy development, or providing more loans to minority and women-owned businesses in the social space, but really tying the rate that you're paying to KPIs, your environmental themed key performance indicators in terms of reducing your own emissions. So I think that's a good way for companies to actually show that they mean it when they make sustainability commitments to reduce their own emissions, saying I'm willing to pay more money to my bondholders if I don't actually follow through with these emissions reductions. In terms of the question that you asked on how the climate risk analysis is informing the product development, I think I don't see that market developed yet. One area that was talked about, again, going back to the CFTC report, is if you can come up with some, climate risk derivatives product, can you find a way of sort of selling into the market the climate risk of financing a certain industry? I won't pretend that we've cracked that nut and sort out how to do it. Obviously, insurance is a big way that you sell your risk to somebody else. But I think in terms of how climate risk is informing our own lending, more what we're working on is, when does this become a factor in the internal credit rating that we assign to specific clients? And do we need to factor this into the capital that we hold against certain loans if industries become very risky? And just the last point, I know, kind of like throwing out a whole spectrum of areas on the opportunity side, but the last point I'll throw out there is that banks are starting to also use the low carbon transition as a client engagement tool. So Citi earlier this year founded a new sustainable banking and corporate transitions group, where we're actually training, 100 bankers across all different sectors on climate risk, low carbon transition, sustainable bond markets, ESG linked products, et cetera, so that bankers across the world, across sectors, can use this not as kind of a compliance lens in their clients, but an engagement tool on how, if they want to continue to be capturing market share, to be capturing, the broad swath of investors as investors chase kind of green and ESG investments, they need to make sure that they have their own low carbon transition plan to transform into the low carbon future.
Well, that highlights the role of the sector that is very heavy between banks and insurance, as well as both industries. And that, Jennifer, the questions are very clear to you from our panelists in terms of driving this transition, in terms of financial markets and centers and their role in driving that transition forward. Eliza posed the opportunity and the market to transfer risk, the different derivatives that we're looking at. It's good to hear from you, Jennifer. How do you see it from financial centers' perspective?
I think certainly speaking, in my role with Toronto Finance International, but also with FC4S, I think all financial centers and the financial sector globally really recognizes, there's opportunities here too. It's something we need to move on quickly. It's critical to not just the stability of our industry, but the stability of across sectors, as we were talking about earlier. So I think in terms of developing that talent base, that's what Eliza was talking about earlier. That's something that we're seeing happen a lot more now. There's a recognition that we need to develop that talent base within our financial institutions. So there's a lot of work happening there internally within the financial sector. And I think that that's very important, because that will allow us then to drive change across the companies that we're involved with, across sectors, and to go out. And I think, really it's sort of incumbent upon the financial services sector to actually go out there and try to educate people. Moira was talking about education around insurance products and insurance risk. That's our job, to make sure that we're really getting out in different industries and broadening out the knowledge base. Again, as I mentioned earlier, the sort of the sophistication around our analysis of risk, specifically to climate risk. So I think it's really a critical role that we play, whether you're in the banking sector, even in the pension funds as well. If you think about, they're clearly global investors. Our Canadian pension funds or institutional investors around the globe are also going to play a very important role in education, in getting out there and asking questions of the companies that they're considering investing in or do invest in. And so I think that that only proliferates sort of the knowledge and raises the importance for everyone. And I think certainly we've seen in Canada that the private sector and the financial services sector specifically has really taken a real leadership role on this front. When you think about Europe, it's perhaps more, publicly driven. In Canada, there's really been a great drive within the private sector to make progress on this and to move forward when it comes to meeting the goals that we've set for ourselves. And so I think, whether you think about, we have an expert panel that was appointed by the government to make some recommendations around what is the path forward here in Canada to transition. And we've seen the private sector really take up those recommendations, take up the challenge there and try to drive progress there. So I think that's a bit of a unique dynamic, perhaps in the Canadian context, that we've seen such leadership from the financial services sector specifically and the private sector. And the other comment I would make is just to pick up on Eliza's point. COVID hasn't, everyone worried at the beginning that we'd take a step back, essentially, and ESG just generally, but climate certainly would move down on the agenda slightly as we try to recover. But we haven't seen that happen at all in the Canadian context. There was a survey that was just done by KPMG of institutional investors here and posed that very question. And there certainly was no sort of downtick in terms of where is climate and action on climate in the agenda for institutional investors. So I think we're seeing that across the sector, which is good.
That is very interesting. And it's very good to see as well, Jennifer, to your point, the task force also making recommendations in Canada for building back and aligning the recovery for Canada to be green, resilient, and sustainable. And I think I would be very happy to hear from you, Moira, on that also Canadian context as well. And in terms of the broader expert panel recommendations, how that provided a market-based approach probably for financial sector as financial institutions, as Jennifer mentioned, and helping you develop a market-based approach to move forward, knowing where the longer-term agenda would be and trying to figure out how the transition is.
Sure. So maybe first move off from Jennifer's point about COVID and did that. Well, and also Eliza talked about it, how COVID did not actually stall the environment or the climate agenda. In fact, one of the aspects that I think is really interesting is that the pandemic has actually brought the intersection or the connection between environment and social issues to the forefront. And that's been quite interesting to see and has brought a new dimension to the work that we're doing. But specifically on the Canadian point of view here, the Canadian Sustainable Insurance Task Force is beginning work to develop actually a roadmap to identify and prioritize issues. we've got a lot of momentum now on the national level, as was mentioned, with the release of the final report of the Task Force for Resilient Recovery. And that aligns with last year's final report on the expert panel on sustainable finance. And the insurance aspects of these reports, they really do focus on the general insurance side. So one of the things we've been looking at is where we've got gaps. And one of the places we've certainly seen gaps is on an understanding of what is needed, what the risks are, and what the solutions are on the life insurance side. Really, there's a need for more study on life and health data to understand the connection to climate change and increasing health risk. And I'd say it highlights the need for a collaboration with other stakeholders to understand what climate changes mean in terms of pollution, changes in the spread of disease and health of green spaces, importance of that, especially in an urban environment. I think that in Canada, some of the work that's already underway on the general insurance side will likely be applicable and inform what we do on the life and health side. So that's a great place to start and to build our understanding. So for one example, if you've got healthy building standards focusing on the life and health aspect, which also take into consideration elements impacting physical and mental health, as well as climate impacts and energy efficiency. That way you're bringing the two pieces together and working on projects that inform both sides of the business. Another area is nature-based solutions. In the general insurance area, the focus is often on mitigating flood impact through things like protecting or building from scratch wetlands in order to protect communities. But in the life and health area, green infrastructure is also very important in that it can also address health impacts.
Well, absolutely. Making that connection across sectors is something that is very beneficial. And I think, Jennifer, just quickly back to you, since we are on the topic of the expert panel and in terms of connecting the dots, and as Moira mentioned, the work of the PSI Canadian Insurance Task Force to build and figure out these gaps and where the focus should be. How do you see the approach was from different financial centers and different approaches? Canada has taken not just the expert panel's recommendations, but also building on the taxonomy to try to start with the reallocation of capital, and that will trigger down the flow and repricing of risk. Would like to hear more from you in terms of the challenges that you're seeing and the opportunities for that.
Well, around taxonomy specifically and some of the work that we're doing here. Certainly as we think about different standards, the work around taxonomy that the EU has undertaken and standards there, very important work. But as we looked at the Canadian context, one of the things that came up in the expert panel's report is this need for transition taxonomy. Canada clearly is a resource intensive economy. Transition needs to take place and capital needs to flow to make that happen. And so there was a recognition that in the Canadian context, perhaps there was additive taxonomy that was required, transition taxonomy, to help facilitate that capital flow. And so there's some work being done right now by the Canadian Standards Association and the financial sector broadly around moving that forward, creating that transition taxonomy to hopefully help capital flow there. We certainly, we're not unique, there's other countries in the world like this. Our economy, certainly with the resource base that we have, transition is going to be a long path, a difficult path. And so transition in those parts of the economy is critical and a challenge that we have. So, I think that there's a growing recognition, certainly within those industries, that transition needs to take place. Certainly in the financial services industry is very, very supportive there. So I hope to be able to report back further on that once we've moved along the path of developing that taxonomy here in Canada.
Well, absolutely, that will be supportive for everybody in terms of aligning that transition. And I think, Eliza, to hear from you, I know that the US market is different in terms of it's more siloed in terms of the progress. And we'd like to hear more from you about the critical issues that, in terms of standardization, data, in terms of our understanding of physical and transition risks and opportunities. Where do you see the challenges are, and how do you think we can move forward on it?
Mm-hmm. Yes, well, I mean, you can't have a climate risk conversation without talking about data challenges, right? Like, I feel like we always come back around to that in terms of the, availability of data, the accessibility of data. And, there are a lot of smart kind of consultants, data providers that have been working on this for a while in terms of how do you marry physical scientific climate data with economic data that banks can actually use, investors can actually use, because, we as banks aren't necessarily going to be able to comb through reams of, precipitation data, heat change data, all of that primary thing. We really kind of need a little bit more of that crunching to happen so that we get data pieces that we can more easily integrate into our financial models to see how it affects our portfolio. And so you're definitely, I think we as well as many banks, we're talking to all of the different data providers. You're seeing that, the 427s, the carbon deltas, are getting acquired by the larger houses, so that now the big credit rating agencies are trying to integrate not just ESG data, but specific climate data into their offerings. I think that's going to be very helpful. But I think, what could be even more helpful, and I don't want to put those people who are doing good work out of business at all. I think all of it's needed, but there's such a focus on bank regulators. What can the regulators require the banks to do to assess the carbon in your portfolio, assess the climate risk in your portfolio? But I would love to also turn it around and see how can, regulators help make this data more accessible, to us? How can they help provide the tools that banks and investors would need in order to do our own climate analysis? I think, one big issue is just emissions, like emissions reporting. There's a big focus on, okay, banks should be doing scope 3 accounting of their portfolios. But, is it really a bank's job to do a carbon accounting for the whole economy, right? I mean, do we need to also be pushing on just kind of more consistent disclosure of greenhouse gas emissions from companies, across the board? And this gets to a question you asked earlier in terms of the different disclosure regimens in Europe versus the U.S. I think you're seeing a broader push in Europe on more disclosure of environmental data. Disclosure within the U.S. sometimes comes with more liability concerns, so I think that will need to be addressed. But can there be kind of more governmental support on getting some of these basic climate risk metrics out there, so that you don't have every single financial actor across the board asking companies the same questions, trying to crunch the data in different ways? Can we have kind of consistent requirements across more sectors to disclose things like greenhouse gas emissions? I think when you get into physical risk factors, that sometimes can be a little bit more, tricky to quantify. But that, and then I'll just go back to the point on NGFS, using the NGFS climate scenarios. I think it's helpful when different banks and different bank regulators are referring to a common set of scenarios. We want to make sure that there's variety of those scenarios, so that it's not just, cherry picking a rosy scenario that we all of our portfolios look good under when we do a stress against it. But, NGFS has a lot of different scenarios you can pick from, and it allows for banks to, again, put our heads together in terms of the methodology you might use, like the one that was, put together under the UNEP TCFD pilot testing. Like, can we put our heads together on how you actually develop a methodology to stress against these scenarios? So there's a role for definitely kind of public-private partnership, I guess, between like governments helping us make this data more available and the financial sector putting our heads together to figure out how you crunch that data.
Well, coming together on that point, Jennifer, to you quickly on that, public-private partnerships and a financial center's role. I think that's very important in terms of democratization, the access to climate data, the initiatives that can be taken there, and especially when we start to look from the bigger companies to the smaller companies. And as we have, and my colleague Paul mentioned, a lot of companies in Canada in particular found it challenging to access lifeline funding because of TCFD disclosure. What do you think your views are on that?
Well, I mean, I don't know that that's necessarily the problem with the LEAF program, but it certainly it was an important statement from the government that disclosure was required. I think, but you know, we in Canada share exactly the same problems globally that others do around data. It is a critical issue. It is the pain point for everyone as we try to move forward with better analysis, better risk analysis, and better disclosure. And so I think, you know, certainly in the context of FC4S, this is something that we talk about amongst different financial centers and the different approaches that are taken globally on this front. We're hoping that, you know, best practices come up, and that's why FC4S exists, is for us to work together globally as financial centers to on challenges and opportunities for the industry. And so we certainly, you know, look to others. I don't think that anyone has any secret sauce, unfortunately, on this front right now. I think we're all sort of trying to figure out what the best path forward is here and looking at other people's approaches and experiences to try to move forward in the Canadian context too.
Well, I think to that, Moira, you mentioned collaboration and across stakeholders, and especially public-private partnerships and a market-based approach. And maybe as an insurance industry in particular, you have participated in the initiative in terms of analytics for Canada, in terms of 3CIA. So if that would be a market-based approach, you think would accelerate and help us in terms of the transition forward?
Oh, definitely. I think that really, we've probably come as far as we can as individual companies and as an individual industry. And the opportunities now are to work with other stakeholders from other parts of the economy, whether it's government, whether it's health side, standard bodies, all of the different resources that are available in the economy to help inform or develop better data, inform better decisions. That really is the point where we're at now, is that collaborative action, the developing data together that everybody can use so that solutions can be understood and accepted generally in the economy. The collaborative point is key at this point.
Well, absolutely. Well, I think as we are coming to the end of our discussion and the top of the hour, I would like to take one question, at least from the audience, and a very interesting question to hear all of your views on and how we can transition forward. As a question is for risk management, whether from a bank, an insurance, or as a financial center, how much do you see your work is to focus on the transition to a low carbon economy or future, or your focus is to decarbonize and exit your portfolios? How are you managing that transition? Eliza, I would like to start with you.
So, yeah, is our job as risk managers to decarbonize the portfolio or to transition? Well, you know, I think Citi, again, large global bank, large financier of the oil and gas and power sector. I think it's going to be hard for the economy as a whole to kind of decarbonize on a rapid time frame. You know, if you talk about coal mining, coal power, that's one thing. But if you look at the climate transition scenarios, even the more aggressive ones show oil and gas demand globally to be relatively flat out to 2040. So I think it's not enough for an individual bank to say, I'm decarbonizing my portfolio, you know, I'm going to stop banking high carbon industries. If the industries are still going to be around, you know, if they're going to still be a part of the economy and you're not really having an impact on decarbonizing the real economy. How much does that actually help? So that's why I think, going back to what I said about, we're using climate risk, low carbon transition as a client engagement tool also. I think the low carbon transition angle can be more impactful if you're talking about an industry like oil and gas that is still going to be core to the global economy for a while. You don't necessarily change anything by walking away from it, but major oil companies are going to be key to the low carbon transition. Them figuring out ways to reduce their own emissions, how they transition their business model to doing something else, and how do we meet the future's energy demands in a low carbon way. So I think for some banks where maybe oil and gas and power is a smaller piece of your portfolio, or for investors, it may be easier and quicker to talk about, do I just reduce my appetite for a specific industry and start getting out of it? But for the economy as a whole, we need to figure out how the high carbon industries transition. And there's an important role for banks and investors. There's an equally important role for government-led energy policy, for pricing carbon across the economy, so that these so that this transition has some financial incentives to happen also, if kind of your externalities of carbon are priced into the economy. So I guess it's a little bit of both, but I know for Citi, we really have been focusing on the narrative of we want to transition to low carbon economy, and we want to transition with our clients rather than trying to kind of walk away from whole sectors.
Well, Jennifer, from a transition of a broader economy as well, and not just oil and gas, and your role as we're asking you to accelerate the transition, bring the discussion forward, as well as a financial center, the element and the integration, as we said, and the intersection of E, S, and G from your role, and especially looking at what the Paris Accords requires in terms of a just transition and for economic stability. What can you tell us about that, and to focus on it in terms of our transition and looking forward?
Yeah, I mean, just to build on Eliza's points, I think she made some great points there, that it does have to be a just transition. And, the economy, it needs to be orderly. And if we're going to be successful with transition, we do need to think about the broader economy. We need to think about how we take industries like oil and gas and have them have a lower carbon footprint, and have them and help facilitate that transition, hopefully to other energy sources. So I think we really have to take a holistic look at this, because if, let's say, you're achieving by just not investing, let's say, in the oil and gas industry, or you can achieve one objective, but you could actually impact some of those other SDG goals in a very negative way, if you think about society as a whole. So I think we really need to think holistically about it. I think it's just too simplistic in many cases just to say we're not going to invest in certain parts of certain sectors or certain companies. I think we have to think about the broader transition, and how can that be a just transition, and how will it be the most successful for society as a whole.
Well, Jennifer, from that to taking it to you, Moira, as they always say, what is not insurable is not financeable. So as the insurance industry is the mechanism to transfer risk, what do you have to tell us about the insurance industry's perspective on that?
Well, as an insurer, the need to take action becomes blindingly obvious. When we get over 2 degrees increase in temperature, we're just in a world where things are just not insurable. So the insurance industry ceases to exist. And obviously, from an economic point of view, that is a catastrophe. So from our perspective, there is no choice. And the imperative is right now. And action is required immediately. I certainly agree with the points of my colleagues on the panel about the focus on transition, and how, especially by looking at the broader social and governance impacts, we can really have a transformative impact on the economy. And the breadth of the impact can be quite fundamental. So I think that certainly is something that has come to the fore during the pandemic. social aspects, stresses that maybe had been hidden from view have now come to the fore. And on those, we have to include that in our programs as well now.
Well, absolutely. I think, Eliza, are you still with us? I can't see a picture there. Just want to make sure that you can hear us.
I am here, yes. Sorry if
Okay.
my connection has gone bad, but
Okay, as long as you are with us, just wanted to double check and on to have you with us on the final closing remarks. I think as we look forward, we've heard from you. There's a lot of opportunity, a lot of progress has been made on the integration and understanding of climate risk. And I would like to say, as we made it through a very tough year and we are still pushing through, I would like to hear from you on a positive note. What would you give us moving forward, starting with you, Jennifer? What are your hopes and your priorities to move forward?
Yeah, well, I think, hopefully as we get into the recovery phase from COVID, I certainly hope that as we think about stimulus spending and different initiatives that we will undertake to help the economy and society recover, that that climate is at the forefront, as we talked about at the beginning of the panel. That it is part of a great lens towards climate is taken when we're thinking about how are we going to recover, where are we going to spend money, where are we going to invest, and so. Certainly, I think we are seeing that in Canada. I think it is part of the recovery plan as we develop it, and certainly hope to see that globally as well.
Eliza, to you. I know the US and the context of uncertainty is not something that financial markets would like to see, but your hopes to see and to transition moving forward.
Yes, well, I think I kind of stole my last point, maybe my last comments in terms of a price on carbon. I think there's a number of things that need to happen to incentivize decarbonization across a lot of sectors. So I know we spoke a lot about oil and gas on the one side. That's the supply question. We need to work across all industries on the demand. To reduce the demand for emitting carbon. We need to make emitting carbon more costly so that there's more incentive to invest in research and development in the low carbon solutions. So I think pricing carbon accurately across the whole economy has got to be a key step that happens quickly, so that we all understand the costs. The costs of acting in the future are going to be much higher if we don't spend this cost now in the present to start the transition.
Well, we hope that we all start spending the cost now. And Moira, from you, to hear from you, the insurance industry usually leads. And your expectations, what are you optimistic about and hoping to see first?
I'm very excited about the willingness of market participants, of companies in the economy to take opportunities such as the report on the experts panel on sustainable finance, the work of the task force, and to take those and implement and to lead. I think that is going to make a tremendous difference in Canada, particularly, and I'm really excited about the results we can achieve.
Well, I am optimistic on that happy note. And to wrap it in time, I would like to thank my panelists and virtually sending the thanks from our participants. To you, Eliza, Moira, and Jennifer, thank you very much for your time. And to build up on this discussion, the next panel will have also further on carbon pricing and the CFTC report from the commissioner. Join us on the Transitioning Beyond Oil in North America. Thank you again and enjoy the rest of the sessions.
Thank you.
Thank you.
Thank you. Bye.
Bye-bye.